I will admit as I see them coming in.
All right. Well, welcome back, everybody. Appreciate you being here. I know there's a lot more to hop on here as we go, but we're going to go ahead and get started because we have a packed session for you today. You know, I say unfortunately, but Steve and I had to get the band back together because if you remember, we were in October and we thought that we could go into tax season, deal with forgiveness and kind of talk to our advisors and come out April, hopefully, on the good side. But little did we know we had, you know, probably the longest. I think that the invitation went out, it said it was the second longest, but then I read that it was the longest piece of legislation that was ever passed. So there is a lot here. Again, I appreciate you being here, and I'm 100% positive you're gonna be worth your time today. So again, as with the previous, we have no new hobbies, no new accomplishments here. So you've seen them before. What we're going to cover today is really the new law that was passed December 27th. We're really going to focus on PPP2. We're going to get into some aspects of that. We're going to get into the expanded, excuse me, tax credits that are available and how they coordinate, and then just kind of a general state of affairs to wrap up. A couple pieces of housekeeping information. This is a Zoom meeting, so we have you on mute, but it is your choice to have your video on or not, so just be careful with that. We can answer your questions as best we can today through the chat function, and you know, it may be a little bit of an effort. Steve's a little bit ahead of me on this subject matter. I spent last week giving presentations to local banks for the annual tax and accounting update, which really didn't have anything to do with this. And I spent the week of December 28th getting ready and developing that presentation. So I crammed over the weekend, and you know, I'm up to speed enough, I think, to at least introduce and probably take a question or two. One last thing is, you will notice I do have a cough, although I do have one of the 90 symptoms of COVID. Please do not call the county and have me taken away in the middle of the presentation. There'll be nobody to advance the slides. And I actually do not have COVID. I am having something else, and hopefully on the tail end of it. I'm on my third antibiotics in 3 weeks here, so I'm hoping that we get going here. So just give me, I will try and mute if I can help it, and otherwise I apologize ahead of time. So Steve, I'll throw it over to you to get us started. Thank you for doing this with me again. And I know you wanted to start with this slide here, so.
Yes, all right, thanks, Brent. Yeah, I had asked Brent to move ahead. I changed the order a little bit last night as I was preparing. But what I wanted to just start out with before we get into all the details, and there is a lot of details today, I just wanted to, well, first of all, say Happy New Year. Feels like it's been a long few weeks here already, but anyway, Happy New Year to everyone, and look forward to going through this with you today. But I just wanted to reflect a little bit on this past year, and that you know, I know it's been really difficult for a lot of people. It's been a hard year, and I just want to first of all thank Brent for getting these organized. This is, I think these have been really beneficial, that we can get this information out to our clients and others that wish to join and get the information. So thank you, Brent, for taking the lead on this. Also, all of our other directors, owners, and staff for those that aren't, that are not showing up on the Zoom, that you don't see their picture, but everybody's in the background and working hard to keep our business clients and our individuals to try to figure out the ways that we can keep businesses moving forward and getting the relief that you need. And so we see that as a big priority here at Canon Capital. And so I just want to thank all of you for, keeping your clients and people up to date on the changes that have been happening fast and furious. And then, I just wanted to go, as I've been thinking about this, I remember a conversation I had with Mike Witter, who is one of the founders of Canon Capital, about 20 years ago. And this conversation still sticks in my mind. And I've been using it quite a bit over this last year. And that, Mike said to me at one point, he said, you don't have to know the answer, but you have to know where to find it. And so I think that's kind of what we've been going through this year. We don't always know the answer, but we've been trying to find it. And I think we've done a really good job of putting that information out there. Many times, we've gotten, as you can see the slide in front of you, the CARES Act came out like back in March, the end of March, and within 2 weeks, PPP loan applications were out there, and we were filing these loan applications, and we had 300 pages of the bill, but we had no regulations, nothing to follow, and it seemed like there was contradictions all over the place, so finally they started putting out these IFRs, and there was, you can see there's 24 of them, over 100 pages. Then the SBA started issuing their FAQs. There was a new, in the middle of that, there was a Paycheck Flexibility Act, which was only 3 pages, which was probably one of the shortest acts ever. And now we come to this new tax bill, and I think there's a typo on this slide, so I apologize for that. It's should be almost 5,600 pages. So that should be 5,600. The exact number of pages, I think, is 5,593, but that's beside the point. And then after that, after the new bill came out, just last week, the SBA issued 2 more IFRs, which total over 125 pages. So along the way, there was issues of who's eligible, can you get the loan? How do you apply? My bank won't accept my bank's too busy, I can't go through them. Where do I go now? So all of those things happened this past year. And we've been trying to navigate that. And I think one of the things that we'll find is many times along the way, we just said, just have patience, the answers will come. And we encourage you not to file for forgiveness yet. And as you'll see today, for those that took our advice and held off on filing forgiveness, you'll see that maybe that was a good piece of advice, and you're be glad that you waited. So anyway, I'll move on. Brent, if we can go back to the overview of the law. So the name of the law is the Consolidated Appropriations Act of 2021. And it's actually made up of two bills, or two pieces of the bill. One is a $900 billion, it's hard to say that number, COVID-19 relief piece, and then a 1.4 trillion resolution to keep the government funded through 2021. So as I mentioned, it's about 5,600 pages. It was passed by the Congress 12/21, and that's after only they had maybe 4 to 5 hours to read 5,600 pages. So I'm not sure how they can read that fast, but anyway, it was passed the same day that the bill was printed. So and then the signing was delayed a few days, but on 12/27, it was signed by the president and passed into law. Some of the key provisions in this little graph, as you can see, was from the Wall Street Journal on December 22nd, but it gives, you know, the dollar amounts of where the relief is supposed to be going. And so there's 325 billion for small business relief, which included in there is PPP 2, if you will. Many people have called it that. And some other grants and loan funding makes up that number. 166 billion is the next largest amount, and that's for direct payments to individuals for economic impact payments, the $600 amounts that are going out currently. There's 120 billion for unemployment benefits of $300 per week through March 14th. Some emergency rental assistance, the eviction moratorium. I'm sorry, my computer wanted to shut down. Anyway, so some rental relief there, and 82 billion for colleges and schools to replace HVAC and virus mitigation processes. 13 billion for emergency food assistance, and 7 billion for broadband expansion for low-income families. All right, and if you can advance that, Brent. Okay, so here's some of the timing, which we've covered some. The bill signed into law. Last week, Treasury issued the 2 major IFRs that explained some of the PPP regulations. And then over the weekend, Friday night, I think they issued the new loan applications for the PPP first draw and second draw funding, which we'll go into that in a little more detail. And then yesterday they started accepting applications. So that the start, though, for those is for lower income, moderate income communities to receive their funding ahead of everyone else. So they opened up early for those. All right, I think you can go to the next one, Brent, and that's kind of how some of us have felt. We're, you know, out on the sidewalk, you know, loaded down with all this paperwork and bills, but could be any of us, Brent, myself, on different days. We all kind of feel that way. But anyway, it's a funny humor to add into this.
Yeah, just they're looking for a CPA, but the CPA is the guy that's under all the stuff buried and hurt. So it's been tough. And you'll see them more as we go through today. We're not close to ending here. So the big news with PPP 2, or the passage of this law, I'm sorry, not 2, but just the passage of the law. Not going to spend a whole lot of time, but we knew that the forgiveness was not taxable, right? That was expressly stated in the CARES Act, but the IRS came back and said, well, there's this existing law in the book that if you pay expenses with non-taxable income, those expenses aren't deductible. And by giving you non-deductible expenses equal to your loan amount, you're basically going to raise your income through the back door for forgiveness. So the big news in this is the deductibility wording was in there. We had expected this all through last summer. We knew it was coming. This is why we didn't rush out. One of the reasons why we didn't rush out for forgiveness, because we wanted to wait and see. That deductibility passage may not have happened until March or April, but they were able to attach it into this bill and have it. So it's the same for PPP 1 and 2. Everything's going to be fully deductible. You do not have to pick up the income on forgiveness either. So this is really, really good news, obviously. Normally if you get tax-free income, you can understand maybe you do have to not deduct the expenses against that because that's a benefit, if you will. But in this case, you don't want to give $300,000, $400,000, $2 million forgiveness, and raise paper income by $2 million and have them pay tax with money they don't have. So we knew it was coming. So we didn't rush to get forgiveness in and stuff like that. So there's other stuff, maybe a little bit beyond, but basis issues, things like that. It really was very, very clear. Congress and the IRS Congress was very mad at the IRS. So I think they drafted this wording very, very tight and addressed everything. And in fact, the IRS had already put out a revenue ruling this year, 2021, saying, oh yeah, the stuff that we talked about last year, forget about it, it's now obsolete. So done deal, and that's where we're going. So now the problem is okay, so you have a loss for 2020, all right? You may not get to deduct that loss because of basis issues, and basis just a fancy way of saying you can't take excess losses in what you have invested into the business. So, excuse me, if you're losing in excess of what you have in the business, your loss may get suspended until next year, but you can carry that forward and take it next year. And there's also provisions for loss carrybacks and such. So again, you have to make some evaluations. It's not going to get lost, but it just may be a little bit of extra work and evaluation to look at here. That's not necessarily a bad thing. If you have a loss carrying over to 2021, you could possibly jump, if your business rebounds and you go into a higher rate next year, it may be worth more next year. So, all's not lost. So, Steve, I'll turn it back over for.
Yeah, and Brent, just a quick comment on that.
Absolutely.
Basis. Basis would be for either a partnership or an S corp. And those entities have different ways of calculating basis. So there's different issues that you can't get into all that detail at this point, but just be aware that there could be some basis issues, and we'll be looking at that for all of our partnerships and S corps to make sure we have the best situation for our clients. All right, so yeah, so now we'll get into we'll get into what has been called PPP2. And in fact, PPP2 is really a combination of two parts with the new law. So it's a first draw PPP loans, people that have already gotten money from the PPP program when it first came out. So they would be first draw. Well, actually, I'm sorry. I said that backwards. First draw would be for new people eligible for the PPP program. Second draw PPP loans are for borrowers that had originally received loans when the program started. The program with the new law added some additional eligible expenses, which we'll be getting into. And the second draw loans have some targeted relief, which you'll have to meet the criteria to be eligible for those. So we'll get into all that detail. But first of all, let's talk about, before we get into the detail of that, who's not eligible. And those businesses that aren't eligible are entities that have permanently closed. And that would be for second draw loans. They're not eligible. Businesses that were not in operation on February 15th, 2020. There's a new program called the Shuttered Venue Operator Grants. If you receive that grant, you're also not eligible for a PPP loan. Publicly traded businesses, lobbying organizations, hedge funds and private equity firms, entities affiliated with People's Republic of China, registered under the Foreign Agents Registration Act. If you're in government, president, vice president, head of any executive department, member of Congress, and own at least 20% of the equity, you're not eligible. And household employers. In bankruptcy, this item is a question mark at this point. That could change potentially going forward, but currently you can't do it if you're in bankruptcy. All right. So, first draw borrowers. So a lot of these rules are similar to the original qualifications that came out when the loans were originally available last year. So 500 or fewer employees, sole proprietors, independent contractors, self-employed individuals, they qualify. The loan, maximum loan amount is 10 million for first draw borrowers. So they did add a new entity that's available, 501c6, which would be such as Chamber of Commerce, tourism, and they would need to have 300 or fewer employees. So that is new in this round, okay? Certain news organizations, they're typically, if they're public certain NAICS codes would be eligible there. Let's see. So we'll get into some of these details a little bit more, but as you can see, there's 35 billion available for first-time borrowers as part of this package.
Steve, a point of clarification. First draw means that they have not drawn previous, correct?
That is, yes, that's correct.
Okay.
These are brand new loans, people that whether they couldn't get them the first time because they didn't apply for it, or you know, newly qualified organizations. So with the new law, they did add some additional expenses that qualify, and we'll get into those details. But with that, that would possibly allow certain people that applied before and got the loan to update their loans to get additional funding from their first draw. I think you can go to the, oh, one other thing that, and we'll cover this also, but you can now select your covered period anytime between the 8 and the 24 weeks. So that's something new, and we'll get into that. But go ahead to the next slide, Brent. Oh, and the SBA did issue a couple on January the 9th. They issued like a one-page sheet on each of the first draw and the second draw. They called it, yeah, it's just like a one-page sheet summarizing who's eligible for each of these. All right, so the second draw eligibility. So as I mentioned, this is for those that have gotten a PPP loan before and meet certain criteria. And the last day to apply, as you can see, for either a first draw or a second draw is March 31st, 2021. So a little bit less than 3 months from now. It's going to be the last day to apply. So second draw loans are for hardest hit borrowers, generally 300 or fewer employees. Now so that's dropped. And you have to have experienced a 25% gross receipt decline in any quarter of 2020 compared to the same quarter in 2019. You have to have used or will use the full amount of your first draw funds. So you can't have any of the first draw funds sitting in your bank account, is what that's saying, when you apply for the second draw. It doesn't mean you have to have applied for forgiveness. It just means you have to have used all the funds. Also the difference, one of the differences here is now that there's a NAICS code 72, which is for hotels, restaurants, bed and breakfasts, bars. They can use 3.5 times their average monthly payroll instead of the 2.5 times a monthly payroll. The maximum amount of the second draw loan is 2 million. Okay. So I think we can go on to the next one. So you have to have a decline of 25% of your gross receipts. So what makes up gross receipts? Pretty much all revenue in whatever form received or accrued. So it's you have to use your method of accounting that you use for your books and records, your tax return. You can't, switch back and forth between accrual or accounting. You have to use the same one that you use for books and records. So sales, products or services, interest, dividends, rents, royalties, fees, commissions, and reduced by any returns and allowances. The only thing that you wouldn't want to include is tax, sales tax that you collected from your clients. So that that you would be remitting onto a government agency. It also doesn't include any PPP funds that you would have received previous year.
Yeah, so just to recap real quick, Steve, there's a difference between receipts and revenue, and you have to have the 25% decline in revenue. Revenue is basically anything, these things that you're going to pay tax on. But the forgiveness isn't taxable income. Loans are not taxable income. If you got another loan from the bank or whatever, you may have sold an asset, that would be part of revenue because you're going to pay tax on the gain. But just keep in mind, again, the difference in revenue, not all receipts are revenue, I guess is what I'm trying to say. So. Okay, sorry, I forgot I had this slide, Steve. Just really quick, other PPP for provisions, not going to spend time on this slide, but there are provisions for farmers, ranchers. Understand there are special provisions for seasonal employers, and then as well as borrowers that may have returned all or portion of their original loans. So you can go back in these cases. So if, again, you were scared about the necessity requirement, something else, and you returned a portion of it or all of it, you can go back and now reapply to get that back as part of your PPP loan back in April, May of 2020, your original first draw, if you will. So that guidance is supposed to be coming out, and we'll talk about that a little bit as well. So other provisions, ways to go back and correct your first loan draw. Excuse me. So as Steve said, the SBA issued guidance on January 6th. All right. And we talked a little bit about PPP2. It's going to use a lot of the same parameters, but we talked about the difference, 300 or fewer employees, 25% decline in gross revenue in any 2020 quarter compared to 19. Now, again, it said on the previous slide, just want to reiterate, a quarter is an actual calendar quarter, not a 3-month period. So you do have to go from January through March, April through June, and so forth, okay? But again, we talked about there are first PPP loans available under those provisions. And again, Steve mentioned this, the NAICS code, if you have that begins with the 72, means that you're a restaurant or some kind of entertainment facility, accommodation, if you will, then you can have 3.5 times your average monthly payroll versus 2.5, which was the original. So they're trying to make a special provision for those industries that were negatively impacted the most. So here, really quick, you'll see I crossed off, and it's not crossed off on what I sent out to you guys. This guidance came out really late. But there are ways to go back and amend your application for your original PPP loan. So if this is everybody, so if you were negatively impacted by changing guidance, you can modify the loan amounts and apply for the difference between what you were eligible for and what you took with the first draw. And everybody is really eligible to go back and amend to include the additional expenses that were not included on the first loan. This guidance that just came out, guidance law that came out December 27th, now says that group health insurance, life, disability, group policies are now part of payroll cost. They were not part of payroll cost on the original application. So if you have very expensive, very large group policies that you're paying, it would probably make sense to go back and amend your first draw. And again, the other ways, if you returned all or part of it, you can go back and get it as well. Now, excuse me, Steve and I were talking this morning about a mistake. When this first came out, it appeared that if you took less than what you were entitled to because of a math computation or something, but that's out the window. But we're kind of dealing with semantics here. So if you didn't include all your expenses, then that if you made a mistake, you can go back and get it, you know, but you can't go get it because you made a mistake. You have to have one of those other expenses. So if you did make a mistake and you have those others, you can go back and, in essence, correct your mistake, if you understand what I'm trying to explain here. Now, here's one of the issues. If the forgiveness was granted already on the first loan, you cannot go back and correct it.
That's forgiveness from the SBA. You've got
correct. I believe if it's applied, and again, the logistics may be difficult, but if you applied but did not receive forgiveness yet, you can get that held up, if you will. So,
I understand there's a way for a bank to pull that back from the SBA, even if it was sent off, you know.
Yeah.
But I'm not certain on that, but that's what I heard.
Well, you know, Steve, once you get government in motion, it's hard to stop. So I'm not sure of the logistics of that, but it's supposed to be possible here. So good luck. But it's there. And, you know, again, you have to make the evaluation if it's worth going back, getting additional first money, if you will, your first money.
We do have a slide that's going to talk about the other additional expenses, all in addition to the group plans. So there is additional expenses out there. Also, we'll cover that in a little bit.
Yeah. Again, as part of the law changes here, the SBA was supposed to create a one-page simplified certification for forgiveness for loans under 150,000. This was rumbling all through the summer and everything as well. There was different dollar amounts, but we knew it was going to be a lot larger than the 50,000 that they were able to do on their own. The SBA was able to do on their own without legislation. So again, that's why we kind of held up here for forgiveness. So instead of going through all the rigmarole, we now have simplified forgiveness, hopefully. However, hold that thought when we get to the employer, or I'm sorry, the employee retention credit. We'll talk about how that credit plays with the PPP loans here.
And just to, sorry, just to interject one key point, just because it's simplified, you still want to keep all of your documentation to prove that should you be audited. So that's a key point, is to make sure you keep all of your documentation to show that you used the money how it was supposed to be used.
Yep, and technically the word is estimated, but you have to actually do it to, again, determine eligibility. So I'm not sure how much, again, it's simplified, but you still, as Steve said, needs the records and everything. Now, one other major point is for those that received a EIDL advance, the $1,000 per employee up to $10,000, that grant that they gave you, whether you got the loan or not, that grant originally reduced your forgiveness for the PPP. So if you got a $10,000 grant and then got a $500,000 PPP loan, the most that you were going to have forgiven was $490,000, and then that $10,000 you would have to pay back for the PPP. This law changed it that idle advance grant does not reduce your PPP forgiveness now. If you have already applied and received forgiveness, my understanding is that you are, the banks and the SBA are going to handle this automatically and get the paperwork to you. Again, you just have to keep in contact with your lender. There's a lot of stuff in motion, and even though that this was passed on the 28th of December or the 27th, there's still a lot that the dust has to settle yet and things get in place here. So, all right, Steve, I'll turn it back over to you to just kind of recap a couple of the other things that we've already touched on. But
okay, yeah, as we did touch on a number of these already, just some key things here to remember is it's a 25% or more drop in gross receipts for any calendar quarter. So first quarter of 2019 compared to first quarter of 2020. Second quarter of 19 compared to second quarter of 2020. So it doesn't have to be, it can be any of those quarters to be eligible for it. It doesn't have to be all of them, doesn't have to be two of them, it can be one of them qualifies you for a second draw loan. Again, the NAICS code 72, restaurants, bars, bed and breakfast, you can use 3.5 times the average monthly payroll cost instead of the 2.5. Load is capped at $2 million, and your covered period, again, you have a choice of that covered period anywhere between so from the time that you originally took out the loan, either anytime between the 8 and the 24 weeks you can use. You don't have to, like at one point we were saying that you had to use the full 24 weeks. You don't have to use that under the new rules. And what we're gonna we're going to come to a little bit later on is we're going to talk about the employee tax retention credit and the interaction between the PPP loans and that. So that's one thing to keep in mind here. All right. Second draw documentation, I think, is the next slide, Brent.
Yeah, I just want to pause for a question. Michael asked, what documentation to prove a 25% drop. We're going to do that on the next slide. Maria asked what the 24-day period was for on the previous slide. So the SBA, Maria, just had 24 days to issue this simplified forgiveness application. So that wasn't one that came out very quick, Steve, right? That we're still waiting on that one, right?
Right, we're still waiting on that. That's just their the timeline that they have to get that the application out, so it's available to people to start filing.
Yeah, they might be a little bit better hitting the deadlines this time around. I know last time I think they were over, if I'm not mistaken. So.
Well, yeah, so far they've been right on target with that timeline that we had early on in the presentation. They've been hitting them, and at least this time it seems like what they're coming out with is pretty clear and easy to follow. Okay, second draw documentation. What's needed to file? So it's generally the same as required for the first PPP loan. If you're using the same lender, then really no additional documentation is necessary to substantiate your payroll figures if you're using the 2019 figures, same as the first loan. Now you have the option to use different figures if you want, but anyway, that if you're using the same and that gives you the best loan calculation, then you don't have to do anything differently. For loans over 150, you're going to need to show documentation on the revenue decline. So you're going to have to show some comparisons from the previous year to the 2020. Whether that's your tax forms, you're going to need some quarterly financial statements, bank statements, whatever you can do to show that your revenue has decreased by that 25%.
Yeah, and just real quick, Dave, just to reiterate, was asking a question, comparing quarter to quarter, calculate 25 on any 3-month period, or must be 3/30, 6/30, 9/30. Again, we covered, it has to be a calendar quarter. So Dave, 3/30, 6/30, 9/30, or 12/31. Here, again, Steve, you said you had choices. You can use 2019 payroll, you can use 2020 payroll, or you can use the immediate 12 months preceding your application. But of those 3 choices, it would make sense if you had revenue decline that probably your 2019 payroll is going to be the highest of the 3. So you would still do your second draw on 2019 payroll. So again, nothing for banks. If you are using 2019, they already have it. Tax forms and financial statements, we got to talk about that. I know the banks are going to push them, and we want to get them done as well. And that's going to be a case by case, see what we can do basis. The employee retention credit, we keep saying it, but it's going to factor in here. Bank statements, if you are on the cash basis of accounting, your bank statements should suffice. Hopefully that they'll go with that. I believe that was the SBA guidance to say, if you were on the cash basis, your bank account statements are good to go. So Steve, I'm sorry, back to you.
Oh, no, thank you for adding that. That was good input. So second draw documentation for loans under 150. So here, in this case, documentation on the revenue decline is not needed to be submitted with the loan application, but must be submitted on or before the date the borrower applies for forgiveness. So the SBA can request it, but I mean, you're going to have to do it anyway at some point. I mean, you would have had to do it ahead of time. So I don't know. It seems to me that you would want to just get it submitted when you do the application, but you're not required to, is the point.
Steve, I don't know if you have questions. I'm getting good questions. Michael's asking, is the quarterly financial statements on the other slide that we just talked about in-house or CPA generated? My understanding is it would probably be CPA generated. What's your understanding?
I think that's going to maybe depend on your bank institution, what they're going to ask for.
Correct. Yeah.
So in the past, they've, there hasn't been consistency between the different, banking institutions. They all require a little bit differently, different requirements. So I would think you could do, maybe they should be acceptable, but your bank might not take them, I guess, is bottom line.
Yeah, I mean, again, there's a lot of dust to settle. I think that's part of it. I'm hoping internals will eventually be okay, because that will be much, much easier and take, quite frankly, just an impossible task off of CPAs here. So, Steve, I'm assuming, do you have questions?
No, I have them all forwarded to you.
Oh, okay.
I have none.
After I said I don't want them, right? So, all right.
No, yeah, you can submit the questions to either of us.
That's fine. So forgiveness, we talked about this a little bit, and we did say that there were new costs. And you can see that, again, this goes back to original PPP, but here's your, gotta get better with my mouse here, but there's your new cost for the group policies, life, disability, vision, and dental. There is part of now payroll cost, which payroll cost is what your application was based on, right? But payroll cost had not included those items originally. So again, you can go back and do the application for those. For forgiveness, there is other expenses here. Worker protection, the PPE cost, so to comply with COVID-19 health and safety, so any of your hand sanitizers, mask, or whatever. But if you put up plexiglass somewhere, or I think even, Steve, one of the examples was if you put a drive-through in, so people didn't have to come inside your building, that cost of the drive-through actually could be.
Absolutely. Yeah, absolutely qualifies.
Yeah, yeah.
Also, restaurants, for example, they've, had to go outside. So anything that they use to set up their tables and serving areas outside is going to qualify.
Mm-hmm.
Some of them in the colder areas, you see the little shelters that they put up, the igloos or whatever, so people can eat outside in the cold. Heaters, all that kind of stuff is going to qualify.
And if you have any of these, excuse me, if you have any of these big expenses, you're going to want to use them to leave payroll freed up, potentially. And again, we keep teasing, but just keep it in mind and be aware that there are these. What's interesting, I don't know that there's a lot of guidance out here yet, but supplier costs, that's a really, really generic term. it's been described pretty much as anything that's needed to keep the business going. But then they say things like accounting fees and some other things are not deductible. So that's just a huge gray area for me right now, Steve. And I think there's a lot that has to come out of there yet.
Well, one of the things I heard it explained as, let's go back to a restaurant, for example. They have to buy their food and their paper plates or containers now that they have to use to serve the food. That's covered under the supplier cost.
Yeah, you know what? I misspoke a little bit. I'm looking, operation expenditures. Supplier costs are your vendor costs. Yes, your direct cost that you put into your good or service. That's probably a little bit more tangible definition of supplier cost than operating cost, Steve. So I'm sorry. I think I heard operating cost is basically anything to keep your business going, but then there are certain items that they were saying were not eligible. So this is the area, I'm sorry, but I think this is the area that's just a huge gray issue for me yet. So, and then property damage cost, if you had any of the damage for rioting or looting or whatever, I'm not sure that that's local here, but potentially there may be a case or two. And go ahead.
Down in Philadelphia, and that areas, some of those areas closer to Philadelphia had it.
Mm-hmm. Absolutely, yeah. I'm just a Franconia boy, so when I say local, I mean Franconia. I don't get out of the fields much. So, but again, here we go is. And I don't want to take too much credit. I think we might have had a little bit of accidental good luck here, but unless your forgiveness has already been granted, then this stuff is out. So, okay, but it does apply to your original PPP loan as well. So, in terms of timing, go ahead, Steve.
Can we just go back to there again? So down at the bottom of your slide, you have the 60-40 split between payroll and non-payroll.
Yeah.
So I think originally, a lot of times we had people saying that, or clients saying that, oh, I can meet all of this with just my payroll because I was able to keep people employed. And so I'm just gonna apply for forgiveness with just my payroll costs and not have to worry about all the other expenses. Well, now I think things have changed, and you might want to save some of those payroll costs and use some of these new expenses that are available to use for forgiveness and save payroll for if you are going to qualify for the employee retention credit. So anyway, we'll be getting to that in a little bit, but just to emphasize that while it's there in front of us.
Yep. And Steve, I'll just say it's 11:30 already, so I guess we have to pick up the pace through the idle so we can get to that payroll employee retention credit. But in terms of timing, what is open now, Steve, maybe this week, I think it's going on weeks. I don't know that they issued dates yet, but just keep in touch with your lender. If you can use the lender that you did before, we would just recommend that. Potentially smaller community banks will come online. There's small community banks in low income communities right now. I think the community banks in not low income will come online, and then the big banks. So just keep in touch with your lender as best you can. PPP2 is going to be on a first come first served basis, so we're going to have to fight that as well and hope that the funding is adequate. So Steve, I'll turn it over to you. And again, we just have to keep our eye on the time. We knew we were going to really be stretched here.
Yeah, first come, first serve, generally speaking, but there is some of that money that is reserved for the lower to moderate income communities. So that there is money reserved for that. So it's not all first come, first serve, but generally, you know, a big portion of it is. All right, so now we're getting out of the PPP area and on to shuttered venue grants. So, you know, this is, you know, something that for me, I know my wife and I, we like to go to movies. We like to go to the theater every once in a while to see shows, and that it's all been closed down. You know, you haven't been able to see anything live. So this is some specific money that's available for these types of places, you know, whether it's opera, live theater production, theater producers, performing arts, museums. So you had to be in operation February 29th, 2020. You had to have a minimum of 25% reduction in revenue in any quarter. Again, kind of similar to the PPP. Any quarter of 2020 compared to 2019. So the grant is the lesser of 40% of 2019 gross revenue or 10 million. So these can be large. You know, they can end up being a large grant. Grant can be used for payroll, subcontractors, rent, utilities, interest. You know, you can read the rest of them there. There will be a priority distribution for these to some of the hardest hit applications or hardest hit applicants. So there's, you know, they have, you know, based on your revenue decline and that kind of thing, they'll prioritize them. Let's see. So these are separate from PPP and EIDL. And you can, as we talked about earlier, you cannot receive this grant if you're getting a PPP loan after 12/27 of 20 for either first or second draw. So keep that in mind. The application is fairly complicated. It's like 29 pages with some complicated rules, but you know, it could be a good thing for those that qualify. And I know we have in our area, we have several of these types of things that would qualify for this. So the next item, this is EIDL loan program, which we've talked about before, but these are more targeted than the previous ones. And they are also subject to, you know, public knowledge. So that anybody that gets these loans, their names are out there and they're published. So, you know, if that's an issue, keep that in mind. Use of funds, they're not allowed to refinance other indebtedness, can't make other loan payments, pay obligations like penalties or settlements, repair physical damage to structure, and you can't distribute, can't use them for distributions to owners or bonuses to anyone, to any employee. Can't be used for same expenses as a PPP loan. So they have to be separate from those funds. If a borrower is an individual or, you know, self-employed sole proprietor, your IRAs could be at risk because this is a secured loan. Reporting would be due to the SBA within 90 days of the loan being paid off. So eligibility, you would need to be located in a low-income community, suffered an economic loss of greater than 30%, and employees no more than 300 employees. So most of the same similar requirements to the PPP2, except for the 30% loss is different than the PPP second draw. And priority is given to businesses that have not yet received a PPP loan. Yeah, let's see. It's idle loans or grants. You know, a loan it's straightforward. It's a loan. You got to provide security for it. A grant, if you get a grant, it's not subject to repayment. Forgiveness is automatic, and it would be considered income when received. Brent mentioned the last bullet point there, grants the $10,000 idle advance is not considered income, and it's not going to affect PPP forgiveness. Let's see, I think you can go to the next one, Brent. Try to keep this moving a little bit. Yeah, there's got to be aware of the needs verification, which I think we talked about. Brent mentioned, did you really need the loan or the funds? So there's a, we could spend some time on that, but we'll just keep going. You can use you can use a PPP loan to pay off an idle if the idle was taken between January 31st and April the 3rd. So that would be the only time that you could do that. This last bullet point there probably should have been on a different slide, but it's a tax issue relating to remote workers. Many of the states, I'll just quick cover it, said they won't tax remote workers if it's related to the COVID. So it's kind of, you got to look at each state to determine if you're going to have a nexus issue for your income tax.
Yeah, so just really quick, if you're in southeastern PA and you sent people to work home remotely because of COVID, and they're working from Jersey, Delaware, and Maryland now, you may have filing requirements in those states because your employees have stepped in those states to do work. However, the states are giving a waiver, but that has to be evaluated on a state-by-state basis.
Yep, exactly.
So, yeah, so that should have been on a different slide. That's kind of my fault. All right. If I could have everybody's attention, this is probably the most important thing that we will have talked about over these 5 or 6 presentations, is with this new law, the expansion of the employee retention credit. Now, the employee retention credit did not get a lot of airtime, if you will, originally, because, and I think this bullet point made it to your slides, but if it didn't, please, make sure, but you could not do this if you took a PPP loan. And most people took a PPP loan because it was supposed to be free and it was a larger dollar amount, most likely. So this didn't get a whole lot of traction. But what it was a 50% credit for wages up to $10,000 all right, a maximum credit. So that gave you a max credit of $5,000 per employee. So if you had 4 employees, you could potentially get a $20,000 credit, right? But again, your PPP loan was probably 150 or 300 or who knows, you know, but a lot more than the credit. It was originally set up for wages between March and January of 21. And again, you had to be fully or partially suspended as a result of the government limits, if you will, and have a greater than 50% decline. So even if you could get into this program, if I can call it that, you know, you couldn't do it even if you had a PPP loan. So there were barriers to entry, and then the PPP loan knocked it out. All right. Here's what they did. And we really need to digest this. And you have to notify your accountant if you think that your revenues may be down and you fit into this category. I will say there's a lot here. We're going to brush over it as best we can. Steve and I took CPE or a webinar over the weekend. They had 36 slides just on this topic. So, you know, there are a lot of complications and what I like to call weeds. We're not going to get down into them, you know, but we need to be aware of it. And you'll see that in a second. So, excuse me, the expanded retention credit is for PPP borrowers that are now eligible, all right, as long as different wages are used. So that's what Steve and I were talking. If you had big dollar items that now qualify, a drive-through window or, you know, plexiglass or something, you want to use those expenses first. If your rent qualified, if whatever qualified, you know, utilities, now there's a 180-degree turn that the incentive is to use those expenses if you qualify for this retention credit. This now is for wages up to July of this year, but they also increased the credit from 50% to 70%. And they reduced, here it is, all right, your year-to-year quarterly decline from 50% to only 20%. And 2021 will continue to be compared to 2019. So that 20% threshold is not going to be a very high threshold to meet, I don't think. And we don't even necessarily have to prove that it's from COVID necessarily. You may have lost a major customer or something else, and you may be down 20% already. And again, it's quarter by quarter. Yeah, so it's not a 3-month period. But the wages are increased to $10,000 per quarter now from $10,000 per year. All right. So you can start to see, I don't have necessarily any examples here, but, you know, a 70% credit on 10,000 wages per quarter, okay, is $7,000. 4 quarters is $28,000 per employee that you could eventually, or, you know, be qualifying for. But you can't use those wages for PPP forgiveness, all right? And they reduced 500 employee requirement down to businesses with less than, I'm sorry, businesses of 500 employees now qualify, not 100. So they raised that as well. Now here's the big one. This is retroactive to the beginning of the CARES Act in 2020. So now we're left with a situation that we have to go back and kind of clean up 2020 and look at quarter by quarter, because the 20% threshold is not going to be very difficult to meet at all. I believe there's a lot of guidance that has to come out here. But I'm led to believe that it would be, I am so sorry, if 19 compared to 20 would retain the 50%, but 21 compared to 19 would be the 20%. But there's a lot here. There is a lot here. And if you, again, feel like you qualify, we have to know that pretty much right away.
And that's a revenue decline by quarter also, right? So,
Yes.
you know, you could be eligible in one quarter and not in another. So you might be, you know, 2 quarters of the year, you might have gone down by 20%, and you still qualify even if your last quarter of the year is up.
Right. So the way it works is if, and Steve, you might have just said this, but I was trying to think of some other points that I want to make too. If you did qualify for third quarter of 20, because the third quarter qualified, the fourth quarter qualifies as well. All right. And you get out of the credit in the quarter that exceeds, I believe, 80% of the previous year. So if you, again, if your third quarter is down by more than 50% or 20%, whatever the measurement is, the fourth quarter would automatically qualify. Even if that's 100% of the previous year, 120%, maybe your sales went up, the fourth quarter still qualifies because it's the quarter after one that did qualify. It's the quarter that you return to excess of 80%, I believe the number is. So even if you had some good quarters, you may qualify. I had mentioned, I alluded to the forgiveness application. 2 things. Again, this isn't, you can't do this if you went ahead and applied for forgiveness. So again, this is why we keep saying, wait, wait, wait.
Well, if forgiveness was granted.
Yeah, I'm sorry.
So
you're right. We really have to be careful of terms here. Sorry about that, Steve. But yes, if forgiveness was granted, you can't do this. The second big item is, okay, so we have simplified applications for 150 or under now. However, that simplified application doesn't spell out what expenses were used. So now we have to figure out, do we want to even use the long application, even if we don't have to, so we can memorialize the expenses that we designated for PPP, so they can't come back and challenge our employee retention credit. So there's a lot of work. And that's why I'm saying the CPA was the guy under the pile of stuff. I'm assuming it was money, but you know, at the beginning of the presentation, I don't know if you qualify for this. We may be looking at an extension, just quite frankly. And I go back, Mike Witter, one of our directors here as well. He said, you know, it's kind of like 2014. And in 2014, they were passing laws as we were going and stuff like that. Issued guidance, frequently asked questions 10 days before the due date of the return. And we just, as a firm, we actually ended up extending every single business return that year except for one, I believe. So I would never thought I would see that, but that was 2014. It's going to be a little bit of the same with this because we do have to do the employee retention credit for 2020 first before we file your return, before we do your individual return in the case of some flow-through entity. So there you go. Again, you need to look at quarter by quarter, and if you feel like you qualify or have, you know, you need to reach out to your accountant right away. Steve, go ahead.
Yeah, like there could be a lot of dollars involved here. So this is a really big big piece of this legislation, I think, for businesses. And like you said, Brent, there's no regulations out on this yet. So we're you know, the legislation passed, but now we're looking for the guidance and the rules and how you actually go back and you know, amend payroll tax returns, you know, 941s and things like that are probably going to have to be corrected. So in addition to, you know, the tax return and taking the credit, but all right. So
anything else, Steve, on the employee retention credit? I'm going to go through the next few slides pretty quickly, but
no, I think, you know, we talked about it, Brent, that, you know, we could potentially have another Zoom call meeting on this, you know, just by itself. So there's a lot of information here, and we're just touching the very basic surface of it.
yeah, our job is to just make people aware at this point. So, okay. All right. So really quickly, one more time, sorry. The extension of Family First paid sick and family leave. This was extended potentially through March 31st, but my understanding is it's not mandatory. You can do this voluntarily. It doesn't cost you anything if you just pay the limits and the government reimburses you for, again, the wages. But employees do not get another 80 hours. If they used any of their 40 hours up or their 80 hours up in the previous year in 2020, I'm sorry, they don't get another 80 hours in 2021. So it's not mandatory, but you know, it's probably a nice thing to do. It doesn't cost you anything in the end. You can work with your payroll provider. Extension of deferred taxes. We have mentioned this before. This didn't gain a lot of traction. I'm not crazy about it, but you cannot pay your employer's share of Social Security and stuff until December 31st of 2021. But all that is doing, unless you're disciplined enough to put it in a separate account and leave it sit there, and you know that you will never touch it, what it's going to do is give you a big, huge bill at the end of the year that you may not be able to pay. I think most of the people want to pay as they go forward. So I didn't see a lot of traction on that, but it is there. The work opportunity tax credit was extended. And this is a certain credit for first year wages on what they term as targeted groups. Targeted being veterans, ex-felons, Social Security recipients, people that have been on unemployment for a really long time, generally groups that for whatever reason have a harder time obtaining a job. So that is now through 2025, so be aware of that. They also made business meals, as long as they were provided by a restaurant, 100% deductible instead of 50% through 2022. And Steve, there's this thing out there that I've heard, I think it was a little bit before my time, but the 2 or 3 martini lunch, possibly. I might have an interest in that at some point this summer for a week or 2. So, but I'll turn it back over to you to take care of the last few slides here, and we'll wrap up. We have about 5 minutes.
Okay. All right. So yeah, included in the bill were some tax provisions for individuals, you know, and things. So I'll try to go through them. I mentioned earlier the $600 economic impact payment, and or for single individuals under 75,000 of income, and $1,200 for couples and child, each child $600. Just the thing, you see the income limits there. Just keep in mind that that's adjusted gross income, not your total income. So there is ways to, if you are over those limits, there's ways to get that down. Maybe, you have a health savings account, you can make a contribution. That'll reduce your adjusted gross income. You have a non-working spouse, you can make an IRA contribution. Those kinds of things can reduce that down so that you get and qualify for those economic impact payments. We mentioned the rent at the beginning, the eviction moratorium. That's through 1/31/21, so not a whole lot longer, but that was in there. You can go to the next one, Brent. Another extender provision. So if you had a flexible spending account and you weren't able to use all your funds, the law permitted that to carry over to 2021, those unused funds. So let's hit some highlights here. I'm looking at my time. Medical deduction is now, and this has been made permanent, as you can see. It's now at 7.5% of your AGI, and that's reduced from 10%. There's changes in tuition. I won't go into that. There's just a little bit too complicated for now. But just keep in mind that there is changes in going forward for tuition and what qualifies and all that. Treatment of certain mortgage insurance premiums as residents' interest is in there. 100% AGI deduction limit for charitable donations for 2020 and 2021. So, you're charitable and you want to put all your earned income, your AGI, you can donate the full amount of that to charity. No reduction in that for 2020 and 2021. Educator expenses, you can now, that's the $250 amount that teachers can use for supplies. They can now use that for disinfectant and personal protective equipment. Charitable for non-itemizers, that has been added $300 for 2020, and it was clarified for 2021 that a married couple can do $600 to charity if you don't itemize, so $300 a piece. Let's see. All right. I think that's.
Yeah, Steve, I was going to take this slide, but I think I want to pull an executive decision since it is 11:59. I have a couple questions here. I think we covered this. Rob says on the ERC, can you apply even if have you gotten forgiveness? The answer is no. But he also did ask, are you saying that if the ERC, if you qualify for, it would at least be 2 quarters, and that is correct. So if you qualify for 1 quarter, it's going to be the quarter following at a minimum. Jerry, we have not received the first payment yet. Is that common? Is there anything I can do? Check the Get Payment IRS page. I believe this has to do with the $600 amount. I would say that they just started that, last week, Steve? So I'm not sure that, most people have gotten them yet.
It might be 2 weeks now, but there's, they have a priority list or however they determine who gets it first. And, you know, I don't know if they go by alphabet or whatever, but you should be getting it. I have seen articles that they are sending out, in addition to direct deposit, they're sending out debit cards. So if they don't have your bank account, maybe that's how you'll get it.
Yeah. Do you have any questions that were submitted in? Otherwise, I'll take and wrap up here.
No, my forward is going pretty good, I think,
Okay.
onto you.
All right, very good. So for those that have 7A programs, literally this will take 30 seconds. 7A programs, they extended those payments for 3 more months. So the SBA will pay your loan for 3 more months. The IRS still has millions of people, millions of unopened mail, you know, so there's obviously they're dealing with stuff as well as we are. I mean, we all are.
Brent, real quick, you can add the postal service there to that also. I mean, they've been horrible with delivering mail over the past month. So when you're sending anything to the IRS, you know, I would say you want to send it certified return receipt, so you have some record of when they receive it. It's just, you know, I got a notice just last week that was dated November 29th from the IRS. So I don't know where it was for almost a month and a half, but sitting somewhere. So all that to say is, when you're sending mail to the IRS, I would do whatever you can to make sure that you can prove that you sent it.
All right, and the status of election, we were going to just cover a couple things at very high level. We do have a presentation on our website for the Biden administration tax plan. So feel free to go to our website. I did that presentation with Chuck Porter. It will go into this stuff for about an hour, I think, on that presentation. Lastly, again, you know, I ask every time if you wouldn't mind taking 5 minutes and leaving us a hopefully positive review somewhere along the way, Facebook, Google. But the most important thing here is we are hiring, and I would love to talk with anybody, ideally 5 to 10 years experience, but I will take 0 to 10 years experience at this point. 12, we could fudge it. If they're just over 10, that's fine. But if you know somebody that wants to come here, have a great opportunity, and a lot of you know how good of a firm we are, we would appreciate you putting a word in for us. So with that, I will say sign off. And Steve, anything else? We can all have a great day then, right?
Yeah, I just say thanks for attending. And if you have any questions that come up, please don't hesitate to reach out to either Brent or myself or any of us here at Canon Capital.
Yep, absolutely. And I'm sure, like I said, this is a holdover for spring, so I'm sure we'll be back. So hopefully we'll be in touch with the reunion tour coming back around. So thank you, everybody.
Have a great day.